Well, as you'll know, Morningstar researchers keep a very close eye on the funds industry, and that includes where investors are placing their money. With me today is Tito Machado from the Market Share Report to talk about this really interesting view of the industry. Hi Tito, thanks for coming in.
Thanks, Nicole.
Tito, you measure the funds flowing into fund product. What can you tell me about the style of investments that are in favour at the moment?
What we've seen during the June quarter is a lot of money flood back into growth assets such as Australian equities, international equities, with investors shying away from defensive assets such as cash and fixed interest, which have been quite popular over the last year to 2 years.
Well, you said flood there, so what? This is a substantial move, not just a hint?
It's just a turn. It looks like it's a turn in the trend, so it's actually a bit early to call it substantial. But, the inflows into retail products is still negative, so a lot of it is actually attributable to growth in share markets across the world. And that would account for the increase in Australian equities and international within multi-sector funds as well as specific asset class funds.
So what does this mean for providers who may have changed their products to offer more fixed interest or other defensive style assets?
I think what we'll actually see is a lot of funds who are index or passive managers who have tended to do well with products that favour cash, Australian or international fixed interest, such as Vanguard, which has been one of the top performers with $1 billion in annual flows, most of it coming via one of their products. They'll commence to struggle as people start favouring more of the multi-sector funds that are highly geared towards growth assets.
So how are retail funds travelling overall?
Retail funds have fared significantly better than they did in the previous quarter by actually increasing by 4.2% over the June quarter up to $280 billion. That's an improvement of $11.2 billion over the actual quarter. With all of this being attributable to market movement rather than flows, which were still negative this quarter and the 6 previous quarters.
So they still have a way to go?
At the current time, it looks like that we might be a few quarters away before we start seeing new money flowing into retail products. And in terms of the actual scale of the retail market, it's still $53 billion from where it was 2 years ago. So it's a pretty sort of clear indication that we've got a way to go.
Thanks for coming in today, Tito.
Thank you, Nicole.